Okay, yeah. How you guys doing? Sorry, it's quite hot today. There's no light, so I'm going to be sweating a little. So you guys should just bear with me. So okay, it just occurred to me that maybe I should be giving you guys assignments. Well, I should be giving you guys small assignments like that. At least for you to it will force you to read more. You know, they say knowledge is power.
You know about that.
They say knowledge is power, and the more knowledge you actually have in forex, the better it is for you. Sorry, let me just quickly. Sorry, I want to place a trade on this. Oh, okay. Don't have enough margin. Okay. All right. So we are going to be discussing a number of topics today. Let me just bring it up. Sorry. Is someone joining us from inside Moto? Okay. So let me just copy this out because I'll use it as a guide. Okay, now, so basically the first information you need to know when it now comes to actual trading, when it now comes to actual looking at markets, looking at charts, the first thing you need to become acquainted with is what is called a PIP. Let me just mute all the lines. There seems to be some interference coming in. Okay. So what is the PIP? I don't know, maybe some of you have heard it before, maybe you've not heard it before. But the PIP is actually defined as the price interest point. That is where you have that PIP. And then sometimes for some brokers, they use PIPs. For some other brokers, they use pipette. That is spelled PEPETTE. Now, what is a PIP? A PIP is the smallest number of the price. You know, most of the prices are calculated in decimal places. So for example, if we look at this pair now, let me zoom in. Okay, even if I zoom in, you might not see this screen very well. But you can see this is the euro dollar right now. The price of the euro dollar is $1. The price of 1 euro is $1.07952. Well, it's changing 953, 956. Yeah, but that last decimal point, 68. Now that 8 is what is referred to as the PIP. The price interest point. So if we say that it has increased by 10 pips, that means it has gone from 1.07965 to 1.0805. Let me just put that up on the screen. Let me open another notebook. Yeah. Can you all see the screen? So if the price of Euro USD is 1.079 0.82. Let me use the most recent value, right? This number, this 2 is your pip. And if this 2 should move to 3, that means it has increased by 1 pip. That is what it means. Now, if it should go from 2 back to 1, it means it has reduced by 1 pip. That is just what a pip is. Any questions? Because we need to understand this before maybe we move on to other things. This last value, when the price is quoted, the last value is the pip. And every increment of that pip, if it goes up 1 number, it has increased by 1 pip. If it goes down 1 number, that means it has decreased by 1 pip. So for example, let me give an example now. If we say that this thing has moved up, sorry. Okay, I think I muted you guys. Sorry, if you have a question, you can.
Okay. Sorry to sound forward, but you know you shared some links with us on the WhatsApp page. Yeah, so I was going through it and it mentioned something about the cash value being quoted to 4 decimal places.
Yeah, we'll get to that. We'll get to that.
Okay.
We'll get to that.
Okay.
Now, it's like I said, there are pips and there are pipettes.
Pipettes, yes.
Now, and some brokers use either one of the two. I'm just using this. Actually, this is a pipette. This particular one, this 2 is because it's quoted in 5 decimal places.
In 5.
I just want to use that to how will I say, just for you guys to get the understanding first, before I now break down the difference between a pip and a pipette and the decimal places. But if I do that before explaining this, it might be a little bit confusing.
Okay. Thank you.
So this last value is either the pip or the pipette. So as it's going up in, okay. So an example, let's just say example. If we say that this has increased by 10 pipettes, let me use the term pipette now so that I won't confuse you guys later.
Okay.
That means it has gone up to 1.07. 992. Exactly. And if we say that it has gone up, this is plus 10. And if we say it has gone down 50 pipettes, it will be 1.07932. 932, yes, 932. So you just minus or you add whatever number you have. If it's 300, you just keep going like that. Now, if it's a pip, if you are looking at pip always stops at the 4th digit. Even if you have another currency, let me show you this. Euro JPY. Can you see this? This is 107.587.
Yeah.
Now, because I know the broker I'm using uses pipettes, so I would ignore that last number and it will mean that the USD, sorry? Is someone asking a question? Okay, so now this is the price of the USD JPY. If I'm going to add the pipette, it's going to be 0.53. But without the pipette, it's going to be 107.58. And if it's going to increase by 10 pips, it's going to increase by 10 pips, it's going to be 107 plus 0.68. And if it's going to reduce by, let's say, 50 pips, is going to be 107.08. That is basically the calculation of the pips. Now, you need to really understand this. The reason is because when you are calculating your profit, when you are calculating your loss, right, the value is the pip value that will be the first determinant. So if your pip value for a particular trade, let's say one pip is worth 10 cents, and you are making a trade and you hope to gain 100 pips, and if one pip is 10 cents, then it means that if your trade gets to the take profits, you are going to earn that 10 pips times 100. 10 cents times 100, which is something around $10. So you need to understand also.
10, 11.
Sorry?
Okay.
Any question?
No, I think it's the same interference you muted for us initially.
Okay. Now, the difference between the pip and the pipette, like I said, is broker specific. Some brokers use pipettes, they use an extra decimal, and some prefer to use just the default 4 decimal places. Reason being, brokers that use pipettes is just a means for the trader to make a little extra income. That means they take that pip, the last number, and they divide it into 10 so that you can even still make, let's say, micro adjustments to your trade. So you can still adjust between one pip and the next pip. You can still maybe take profit or take a loss in between pips. So you don't have to wait for it to move from 1 to 2 before you either take your profit or you take your loss. If it gets to 1.1 or 1.2 or 1.3, you can still take your profit at that stage before waiting for it to get to 2. Do you understand? Now, if you look at this, you can see here that, like I said, this particular broker that I use, Forex Time, the pip value here is 107.56, and then the pipette is now given as a small number because it's actually not a real pip. You understand? It's like a pipette, like I said, it's just the last pip and then broken down into 10 places. So anytime you see it like this, the pipette is always depicted as a very small number. So is that clear? I think I'm going to mute all other lines now. If you have any comments or if you have anything, just indicate. So where is the controls? Tunde, please help us to mute your line, right? If you're not talking. Okay. So that is the pip and the pipette. I hope we are all conversant with that, so that we can now move to the next thing, which is the spread. Now, before we talk about this, before we talk about this,
yeah.
Help us mute.
I've muted.
We are still hearing you.
I've muted. Sorry.
Okay. All right. So now the spread, right? The spread, there are a few banks that determine that quote the price for all currencies. We don't need to go into which banks and whatever. We don't need that information. Now, they're the ones that provide the brokers with the price, with the quote for every currency at any given time. But the broker is now like reselling that pair to you for a small gain. And that is the spread. The spread is kind of like when you go to Bureau de Change and they tell you to buy, if you have Naira, you want to buy dollar. The rate is 360. But if you have dollar, you want to buy Naira, the rate is 363. That 3 Naira, that is the spread. That is how Aboki makes his money. That is how Aboki feeds himself. That 3 Naira difference, or 5 Naira, or 10 Naira, depending on the period. You know, when, like I said, when it gets to all these festive periods, the spread tends to increase. But when people are not really buying dollars like that, or there's not much activity in the market, the spread reduces. So that spread, also brokers do that. When they get the value of the currency from their providers, let me put it that way, they now resell it to you at a small difference. That is why if you look at this, if you can see the screen at the top right-hand side, you can see that the sell, if you are going to sell, you are selling at 107.55. And if you want to buy, it's 107.57. So there is a spread of 2 pips. That 2 pips is the broker's own. So anytime you want to enter a market, enter a trade, let's say you want to buy, instead of buying at 107.55, the broker will sell it to you, will enter that trade for you at 107.53. Let's say you wanted to enter at 55, it will enter at 53, and it will keep that 2 pip, whatever the value of that 2 pips is, that is the broker's money. Also, when you want to enter a trade, when you want to exit a trade, if it's this particular currency, we've already established that this currency is 2 pips, the spread is 2 pips. When it's about to exit a trade for you, it also takes that 2 pips for itself. So the broker makes money when you enter the trade, the broker makes money when you exit the trade. So whatever you do, whether you make money or you lose money, the broker must always make money, because the broker is making, what's it called? The broker is making money off the spread. Now, there are different types of brokers. Maybe along the line, we'll get into that. There are some brokers that are not really regulated, and because of that, they do some shady deals. But primarily, most brokers, FX brokers, binary brokers, and things like that, options, and most of them, this is the primary way in which they make money from the spread. Every time you place a trade, the broker gets a commission out of that trade, which is the spread. Is that clear to everyone? Let me just unmute the lines.
Clear.
Why is it that this control always doesn't want to come out? Yeah. So I hope it's clear to everyone. Tunde, are you clear with that? Samuel, are you clear with what I just explained?
That's fine, it's clear.
It's clear, right? Because I will give you guys assignment. You know, that is how, when we were in school, when the teacher...
Sorry, I'm in transit, so I'm a bit distracted. Can you just recap a little?
Which part do you want me to recap?
The pips you are talking about. I didn't really get much.
Is everything you want us to start again from the beginning?
I'm sorry, please. Apologies.
Okay, let me do a quick recap, right?
Okay, just a recap. Yeah, thank you.
Now, let me go back to this. I said that when the price is quoted, right, you see it like this, 107.58. Some of them will have another value by the side. Let me use the most recent price now. This is 51515, right? Some brokers will give you an extra decimal like this, but some will stop here. Now, this last one, this 51, this one is the pip, but this extra 5 on it is the pipette. That means that the pip has been broken down into 10 extra decimal places, just to give the trader some flexibility. So I don't need to wait from one pip to another pip before taking profit or before taking loss. I can enter or I can exit a trade in between pips. But the most important thing there is the pip. The pip is the smallest value or the smallest decimal of which a price is quoted. So if the price increases by 1 pip, let's say, okay, you know, when I started recapping it for you, it was 107.51. Now it's 107.54, meaning that it has increased by 3 pips. And if it's going to reduce by 3 pips, let's say from that 5.1 to 3 pips, from that 5.1 is reducing by 3 pips, it's going to be 4.8. And then the value of the pip, each different currency carries a different pip value, because the exchange rate for each currency against the dollar and each currency against itself is different. So they don't all carry the same pip value. So when you are trading, you need to know that. There's a formula to calculate the pip value, but I think is a little bit, it's not necessary per se to know how to calculate the pip value. You might want to research that on your own and find out how to calculate the pip value, but I think it's not particularly important. All you need to know is to be able to calculate the number of pips. The pip value you can always get from your broker before you enter a trade. So that is pips and pipette. Pipette is like the last pip broken down into fractions or into 10 decimal places, into an extra decimal place. Okay.
Okay. Sorry, can I quickly ask a question?
Go ahead.
Okay, you said that I can get the pip from my brokers before entering a trade.
Yes. When we get to when we start executing trades, right? When we get to the point where we start executing trades, I'll show you guys how to do that.
Okay. Okay. All right. Thank you.
All right. So now, I also talked about the spread. The spread is what the broker makes. I think Nepo has brought light. So the spread is what the broker makes for each trade that you place. When you enter the trade, the broker makes his money. When you exit the trade, the broker also makes his money. And that difference between what the actual price of the currency in the market and what the broker sells it to you at, that is the spread. That difference, the spread is different for each currency. Okay, for the USD, Japanese yen, we've already established that the spread is 2 pips. If we come to the Euro USD, because the Euro USD is the most traded pair around the globe, the spread for the Euro USD is usually quite low to attract people to come and trade. You will see some other pairs that the spread is so massive because those pairs are more risky. There are not so many people trading them. So the spread is usually higher. You can see now for the Euro USD, let's calculate the spread for the Euro USD. me do this. Let me just go down. You can see the bid price is 107.86. We'll stop at that. Well, let me go low. Okay, no, let's leave it at that. And you can see the ask price is 1.07. Okay, it's changing, so we can't really. But I think if you just look at it, 8688, you can also see that the spread there is two pips. Sometimes the spread can be lower than that for the Euro USD. If your broker is using what is called a floating spread, that means the spread can increase and reduce depending on the volatility in the market. If we look at gold, you can see the what's it called? The spread of gold. You can see 17.27. There's a lot of activity in the market right now, so it's not so stable for me to get stuff for you. Okay, let's look at this pair. This is the Great Britain pound and the New Zealand dollar. You can see the difference here, 2.0525 and 2.0552. That is telling you that's a spread of about 27 pips. The Euro USD has a spread of 2 pips because it is frequently traded, but the pound New Zealand dollar has a spread of 27 pips. That means that before you even enter the trade, the broker is going to charge you 27 pips. Now imagine if, based on your lot size or whatever, you have already, the value of 1 pip is like $1. That means the broker has already charged you $27 before the trade even starts. And when you want to exit the trade again, the broker will charge you another $27. That's what it means. So is that clear for you guys? Hello?
Yes, it's clear. Let's move on.
Okay, now.
Yeah, it is.
Okay, now moving on to the next thing, we're going to look at leverage, right? We're going to look at leverage, we're going to look at margin. Now, basically, when you leverage, if from, let's say the physics definition of leverage is when something small is relying on something stronger than it or something bigger than it to achieve, or if you are using or you are getting help to perform a task that ordinarily you on your own cannot achieve. That is leverage. That is, your uncle is a politician. Because of that, you are arrested. You can use that leverage to get yourself out of jail. Ordinarily, on your own, you are a nobody. But because your uncle is somebody, your uncle is a big guy, your uncle is a rich guy, because of that, you can use leverage to get out of jail. Or when it's time to get employment, you can use the leverage of your uncle or your father or your mother or whatever to get a job somewhere. Something ordinarily on your own you can't achieve. Someone else is backing you, someone else is helping you to now achieve this thing. That is leverage. So if we're going to bring that into the world of Forex, yeah. Now, I mentioned in yesterday's class that there are institutional traders and there are retail traders. Institutional traders trade in billions of dollars. Their orders, when it comes in like this, is not $100, it's not $50, it's not $20, it's not even $1 million. It's in billions and billions of dollars that they use to buy currencies. But all you have is just maybe $100, $200, and you want to play in that market. That means that you need some kind of help. You need someone's assistance. You cannot use your $100 to be competing where people are mentioning billions, 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 billions. So that is where leveraged trading or leveraged markets come in. That is now that your broker is providing assistance to you to allow you to trade with more money than you have. So that means that if I have $1,000 or I want to enter a trade with $1,000, depending on the type of margin or leverage that I have, the type of leverage that I have with my broker, that money can be as much as 100 times or up to 400 times, or even sometimes 1,000 times bigger than the amount that I have. Now, let's say I have $1,000 and my account is leveraged 100 to 1. That means the broker can give me times 100 of what I have. It means that I'm controlling up to $100,000 in the market. What I actually have is $1,000, but what I am worth in the market is $100,000 because my broker is backing me. Now, there is a little bit more complicated than that. It's not like the broker is actually giving you $100,000 or no. But because the reputation of the broker is behind you, they can do a trade with you of up to $100,000. No stress. Now, there's a good thing about leverage trading and there's a bad thing about leverage trading. The thing about leverage trading is that you stand to make a lot of money when you are leveraging. If the trade goes in your direction or it goes in your favor, you make a lot of money when you leverage. But at the same time, if you lose money while you are leveraging, in some cases, you can now even owe more than what you started with. You might start with $100. At the end of the day, you are owing maybe $2,000, $3,000. It can happen like that in some rare cases. So that is leverage trading. Now, let me from leverage now move into move into lot size, because we'll use leveraging to explain a little bit about lot sizes. Now, a standard lot size is the amount of money you are putting forward to place a trade. So if I want to place a trade, most brokers allow you to place trades as low as $10 per trade. Remember that these accounts are leveraged. So that $10 in the market might be worth something like $1,000 or $2,000 because it is leveraged. So like I said, a standard lot is $1,000. That is how it's calculated universally in the world of Forex. One lot is $1,000. Now, depending on your broker can now break that down into different categories, depending on the type of customers they have. Now, you can see my screen now. I've brought up the execute, the screen where you can execute an order. Let's say you want to sell or you want to buy. We'll still get into this as the course progresses, but you can see here volume. If you click on volume, you would actually see a list of different lot sizes. You can actually go, most brokers allow for you to go up to, 100 lot sizes. That means you can place a trade with your own money up to $100,000. Above that, they will not allow you because you are a retail trader, you are not an institutional trader. And also you will notice that they allow you up to 0.01 lot sizes. Remember that one lot size is $1,000. So let me bring up the calculator. Let me show you something. Calculator. If one lot size is $1,000, then what is the value of 0.01? Sorry, it's going to be times 0.01. That means 0.01 is $10. That means that your broker allows you to trade up to or as low as $10 per trade. That means that when you are placing your trade, you are less at risk. You can decide to increase your risk, that is up to you, but you can place a trade as low as $10, that is 0.01. Let's say you want to place a trade, maybe you've been placing your trades and you've been successful up to a point, you want to increase your lot size, you can increase it to 0.02. Remember, 1,000 is one lot size is 1,000. So 0.02 is 0.02 times 1,000, which will give us $20. Let's just confirm that in case we have doubting Thomases amongst us, times 0.02, that is $20. If you want to place a trade of $50, you go up to 0.05. That allows you to place a trade of a value of $50 in the market. Any questions? Any questions?
Not for now.
Let's move on.
Okay. Seems we're getting towards the end. Okay. Now, let me see. Sorry, let me just look at what we have for tomorrow's course. Let me introduce you to some of those things, right? Okay. Because we need to talk about some of these things before we talk about the trend. That is the candlesticks, types of candlesticks and time frames. So let me just introduce you guys to candlesticks. A little bit of candlesticks, right? We have what is called Japanese candlesticks, which is basically what you are looking at on the screen. You can see some are colored black and some are colored white. Each of those candles represents a particular, the market activity within a particular period. That means that you can configure this to your taste. Let me show you. Okay, you can see this looks different. You can use different colors to depict whatever you want to depict on your screen. But the thing is for you to have the basic understanding of what a Japanese candlestick is. Now, so looking at this, we can see that, let me zoom out. You can see when this period, you can see that when you have more of these white candles, you can see that the market is going down. And you can see anytime we have more of these black candles, you can see that the market is going up. Let me use the one with the other color. Maybe it will be more visible. You can see when you're having more of this red, market is going down. But when you're having more of blue, the market is going up. So as I said earlier, each of these squares, this rectangle, represents the activity of the market within a given time period. Now, you can have different time periods. You can look at the market if you want in 1 hour. You can look at it in 5 minutes. You can look at it in 15 minutes. You can look at it daily. And basically what it means is that, let's switch to daily. It means that, let me use this red candle, right? This whole red candle that you are seeing here, this is everything that happened in the market for that day. It represents everything that happened in the market that day. And how do you know what happened in the market? The thing about Japanese candlesticks is that Japanese candlesticks always have an open, a high, a low, and a close. That means you have a high, low, and close. What does that mean? What does that mean? It means that you always have an open price. You always have a closed price. Open price is the price the market opened for that day. At the start of the day, what was the price of the instrument, or what was the price of the currency pair that you want to trade? That is the open price. At the end of the day, at what price did the market close? That is the close price. Now, between the open of the market and the close of the market is going to fluctuate. It's going to go up and down, up and down, up and down. The highest point the market got to, that is the high. And the lowest point the market got to, that is the low. So you have your open, you have your high, you have your low, and you have your close. It is, when you are reading about it in Forex books, you see it is depicted as O, open, high, low, and close, OHLC. Open, that's the open price. Opening price. Then high is the highest value recorded, and low is the L is the lowest value recorded, and then C is the close price. Now, this is the same for any time frame you want to look at. Now, like I said, the example we're making use of now is the daily time frame. So that means that on this day, what day was this? This is the this is the 6th of March. On the 6th of March, the market opened at 203.0009. That was the open price. And the low price, and the close price was 200.806. That's a difference of almost 300 pips in one day. Now, the highest price market had for that day is 204311. And the lowest price is just a little bit below the close price, and that's 200712. That is how you calculate your open, high, low, and close. Now, the color of the candle tells you the orientation. If the close price, the price at which that candle closes, is lower than the price at which it opened, that means that the candle sold. That means that the currency sold for that time period. But if the close price is higher than the price it opened, let's say this particular currency opened at 10 Naira and closed at 12 Naira, that means that within the course of the time period you are looking at, from the open price to the close price, it appreciated in value. That means it went up. But if it starts at 10 Naira and at the end of the day, the value is 4 Naira, that means that within that period of time that you are looking at, the currency came down. That means it sold. It will be, in that scenario now, it will be a red candle because it sold. But if it went from 10 to maybe 18, that means that it appreciated in value, and that will be a blue candle. You can configure it to, when we get to that point, we'll talk about how to configure your chart and everything. And I advise you also you can download it on your phone, you can download it on your laptop. It's called MetaTrader 4. You can open a demo account and you can start playing around with all these things. Now, if you notice, most times the the close price is the opening price for the next candle. If a candle closes at $11, the opening price of the next candle will be $11 because it's continuous. The price is continuous. But there are some times that you have gaps. You can see here, the open and the close price was pretty much the same value. But you see the next candle now opened significantly lower than the close price. But if you look from here, you can see that the close price is always the opening price. It closed here, the next candle opens. Closes, next candle opens. But you can see here, next thing you have a jump. That's a gap. That usually happens over the weekend. When the markets close at 10 p.m. on Friday, by the time it opens on Monday, sometimes you observe a jump in the market because the Forex market actually never stops. It's always continuous. But because the broker closes at 10 p.m. Friday and the other things are happening in the market, by the time you come Monday, you might say a different price. It's not going to be, the open price of Monday might not always be the close price of Friday. That's how it is. Are there any questions? You guys should be having questions, or because by the time I start firing some of my own now. Okay, so we have candlesticks, we have the open, high, low, and close. Now, there's another type of candlesticks. It's called the bar charts. Now, the bar chart is a little bit more complicated to read, but it is pretty much the same thing. You still have your open, you have your high, you have your low, and you have your close. When it's when it's blue in color like this, you know that the candle went up. It appreciated in value. That means the close price is of higher value than the opening price. And if you look at this candle that sold, you can see the opening price and you can see the closing price. You can see the closing price is lower than the opening price. But you can see that this one is a bit more complicated to study than something like this. Most traders that I know, including myself, prefer to look at candlesticks like this. We also have line charts, which is something like this, but this is used by people who, I don't know, their own is their own is strong. This one is strong. So basically that is candlesticks. Now let's look at time frames. You know, I said that a candlestick represents the activity or the price activity of a pair within a time frame. So you can have different time frames. Now let me look for a very good example. Let us look at Brent oil, right? This is a chart of Brent oil. Let us go to monthly. Now, what it means is that each of these candles represents 1 month. This is January. This yellow candle, this white candle is January. This second white candle is February. This third very big white candle is March. And the last candle is April. We are still in April. The candle has not closed yet. So it is on the April is how many days? I think 30 days. Let me confirm. Yeah, April is 30 days. So on the 30th of April, this candle is going to close. So it will, for now, the highest point Brent crude oil has gotten this month is $37. That's for Brent oil. The lowest price it has gotten this month is $19, $19.21. The present price of Brent crude is about $24.48. So that is how you read a candle bar. You can see now that monthly, if you are looking at it from the monthly perspective, you can see that you have more white candles than you have the black ones. And you can see that anytime you have a black candle, that black candle is usually not as big as the white candles. The white candles are more in number and they are also bigger in size, meaning that we have a very strong downward momentum. We're looking at it from monthly, right? We can now look at it also from the weekly perspective. You can see that from weekly as well. Let's start from here. This is the this is also January. This is the 5th of January. You can see that there has been more white candles than you have black candles, and the white candles are bigger than the black candles. This is the only really big black candle that you have here. So each white candle and each black candle depicts the price action within a 1 week period. Now, something interesting I want you to see, you can see that there's a gap here weekly between this candle and this candle. There's a gap. But if you go to monthly, you don't see that gap. The reason is because the gap happened within the month. So when the month candle is being calculated, it doesn't take note of this gap. All it knows is that this is the start of the month, this is the end of the month. Between this and this, all of this happened. It doesn't start saying, oh, there was a gap. Then when you go to monthly, you now see a gap between this the candle is space in the inside. No. It just looks at the open, the high, the low, and the close for that month. But within the month, when you come a little bit lower, you can see that a gap happened weekly, but not monthly, because monthly only takes into consideration what happened for the whole month. Now, we can even go down into daily now. Let me scroll back a little. Let's see if we can go back to January. Yeah, this is January. This is where that move started. You can see also on the daily time frame, each of these candles represent 1 day. You can see that you have more of the white candles than the black candles, again confirming that the price has been on a steady downward momentum. Now let's jump down to 1 hour. Now, if you come to 1 hour, you know, on monthly, we have been looking at it that price is going down steadily. On weekly, we have been seeing that price is going down steadily. On daily, we have been seeing that price is going down steadily. But if you come to 1 hour, what are you noticing? You can see that since 8 a.m. on the 22nd, yes, that is yesterday. Since 8 a.m., the 22nd of April, we've been having more black candles than we have white candles. Can you see that? That is the unique thing about what do you call it now? About time periods or time frames, right? Each time frame can show you something different. You might be looking at it from one time frame and say, oh, the market is going down. But another person looking at it from another time frame will tell you that no, the market is going up. It all depends about the perspective, the time frame with which you are looking at. Someone who just trades on 1 hour chart will tell you that the market is bullish, the market is buying. But someone who is looking at it from daily will tell you that, no, that market is selling. Someone who's looking at it from weekly will tell you that, someone who's looking at it from weekly will tell you that, oh boy, that market is selling. No. Another person might be looking at it from 15 minutes and be telling you that, I'm seeing more black candles than I'm seeing white candles. So see all this place, black, 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 black. It's just recently that we are seeing white candles. So it all depends on the time frame that you are looking at. That determines the direction in which the market is moving for that instrument, which now takes us into what is called trend. The trend is the, how will I define trend? Now, trend is the general direction of the market. The market doesn't move in a straight line. You can see here that this is the weekly chart for, can you guys hear me? It's telling me that my internet is...
We can hear you, but we're not seeing your desktop anymore.
We are not seeing the desktop anymore.
Are you seeing it now?
Not yet.
Okay. How long ago did the screen go off?
I'll say close to a minute.
Oh, okay, sorry. You just gave me a notification now that my internet connection is slow. So, okay, like I said, we'll still, what I'll do is that I'll upload the videos to YouTube for you guys to watch, because the videos is a little bit too large to share on WhatsApp. So I'll just post it on YouTube so that you can go there at any time and watch and replay, catch anything that you missed. Now, so is my screen still showing?
No.
We can't see.
Okay, so I think, okay, let's take a pause there, right, for today.
Okay.
Maybe we'll start again by 6 o'clock tomorrow. We'll continue on trends 6 o'clock tomorrow. What I'd like to do is I'd like to give you guys an assignment, right? Let me do teacher. I'll give you guys an assignment, right? And I would like you guys, it's not going to be very complicated. It's not going to be, it's just something fun, something for you to just show that, yes, you are picking up on what we are discussing, right? So I'll just drop some questions on the group chat. But so that there won't be expo, I'd like for you guys to reply individually. Just direct message to me with a response. Then I'll just share, maybe whoever is the winner. Maybe there'll be a prize for the person, I don't know, at the end of the day. So I'll be dropping some revision questions for you guys on that. And maybe tomorrow during class we can also go through it as well. So I hope you guys, I didn't bore you too much. I didn't waste too much of your time today.
That's fine. But please, I have like 2 questions.
Okay, go ahead.
Okay, the first one is you mentioned the time the trade platform closes on Friday, so 10 p.m. Friday.
Yes.
You didn't mention for the open.
Okay, it opens 10 p.m. Sunday morning. I mean Sunday night.
10 p.m. Sunday night.
10 p.m. Sunday night, yes.
Okay. Then you said we should download something for demo version.
MetaTrader 4. I'm going to
Meta.
I'm going to send it to the group.
All right, that's fine.
Meta, it's easier to download on the phone. If you want to download on the laptop, most brokers prefer for you to download from their website. I can give you guys a link if you want to. You can even register a demo account and do something. But if you want to download on the phone, you can just download on the phone and create a demo account and start trading. But if you want to do it on the laptop, you need to go through a broker's website, download from their site and things like that.
Okay, that's all from me.
Okay. All right, guys. Have a lovely night rest. Please maintain social distancing, keep safe, wash your hands like 1 million times a day. look for hand sanitizer. Please and please keep safe. The numbers that are coming out on this COVID is scary. I would like for all of you guys to, as much as possible, try and keep safe. So you guys have a lovely night rest.
You too, sir.
Thank you.
You're welcome.
Thank you, teacher.